Gold hit $5,500. Cathie Wood still chose Bitcoin. Cathie Wood just went live on television. She looked the entire financial world in the eye and she made a statement that sounds completely insane.
Bitcoin is the first global digital monetary system in history.
Bitcoin is undoubtedly superior to gold. Right now, that makes zero sense. We're in the middle of a brutal global panic. Trump just slapped a 15% tariff on the world. The markets are bleeding out. Bitcoin has plummeted 42%. It just erased over $1 trillion in wealth. Meanwhile, physical gold is doing exactly what it's supposed to do. It just hit a record-shattering $5,500 an ounce. By every traditional metric, Bitcoin has failed the ultimate stress test. Wall Street is bailing out, economists are laughing. While everyone else is panicking, Cathie Wood is doing something shocking. Her firm is quietly buying millions of dollars in crypto infrastructure. Why? Because she sees a massive structural shift happening right under our noses. A demographic time bomb that traditional finance is completely ignoring. And if her math is right, this current crash isn't the end of Bitcoin. It is the final shakeout before the greatest wealth transfer in human history. The macro panic. To understand how crazy this claim is, look at the market. It is late February. The global economy is completely melting down. The administration just dropped a massive policy shock. A 15% global import tariff was announced out of nowhere. Geopolitical tensions are simultaneously flaring up. Investors hate uncertainty. When uncertainty hits, money flees to safety. This is exactly what happened. A massive risk-off shockwave ripped through the markets. Bitcoin, which had peaked near $126,000, fell off a cliff. It shattered critical support levels. It crashed violently below $65,000. In just 139 days, $1.21 trillion vanished from the crypto market. That is a staggering 42% drawdown. The weekend before the broadcast was an absolute bloodbath. A violent leverage flush triggered $2.56 billion in liquidations. Forced selling cascaded through the derivative markets. The global sentiment index plunged into extreme fear. But physical gold told a completely different story. Gold surged to an unprecedented all-time high. It broke past $5,594 an ounce. It proved the legacy macroeconomic models right. Investors sought a tangible, traditional safe haven. This created a historically massive divergence. Bitcoin and gold had a negative 69% correlation. They moved in completely opposite directions during peak stress. This directly challenged the entire digital gold narrative. If Bitcoin is digital gold, why is it crashing when gold is soaring? The answer lies in a massive structural illusion. The ETF Exodus. We were all sold a very specific narrative. When spot Bitcoin ETFs launched, the story was simple. Wall Street money would provide a permanent price floor. Trillions of dollars in retirement accounts would stabilize the asset. We thought institutional adoption meant the end of wild crashes. We were totally wrong. Instead of stabilizing the market, ETFs became engines of distribution. They became highly efficient exit liquidity. Between October and late February, $8.5 billion fled these funds. It was a severe, systematic, institutional de-risking event. In the 5 weeks before Wood's interview, the bleeding accelerated. Spot ETFs saw continuous net outflows, totaling $3.8 billion. Wall Street was dumping its digital gold. They stripped the market of its primary price support. By granting Wall Street frictionless access, we inherited their panic. When recession fears spiked, institutions dumped shares via algorithms. Financializing Bitcoin actually increased its vulnerability. It did not insulate the market from macroeconomic shocks. Traditional finance giants like JP Morgan seized on this. They formally warned private wealth clients against Bitcoin. They cited its outsized volatility and inconsistent correlations. To legacy wealth managers, a 42% drawdown destroys the store of value argument. The traditional finance system was loudly declaring victory over crypto, but amidst this deafening institutional retreat, one entity moved differently. The contrarian bet. Cathie Wood is no stranger to market punishment. Her firm, ARK Invest, focuses exclusively on disruptive innovation. She completely ignores traditional, backward-looking financial benchmarks. She takes highly concentrated, high-conviction bets, and she is willing to absorb extreme short-term pain for long-term gains. She calls these the arrows taken by pioneers. But she didn't just go on Bloomberg to defend Bitcoin with words. Her capital deployment spoke much louder. While retail panicked and Wall Street liquidated, ARK bought the dip. They aggressively acquired crypto infrastructure equities. They deployed millions right at the local market bottoms. ARK bought over 212,000 shares of Bitmine. That gave them leveraged exposure to millions of staked Ethereum. They purchased massive blocks of institutional exchange infrastructure. They dropped $12.4 million into Robinhood shares. This is an astonishingly asymmetric risk tolerance. Traditional theory dictates reducing exposure to assets with negative momentum. Wood did the exact opposite. She aggressively averaged down on her highest conviction thesis. She did this exactly when market participants were the most fearful. A public declaration was a vocal reflection of deployed fiduciary capital. She wasn't just talking, she was betting the house. And she was doing it based on simple, unbreakable mathematics. The mathematics of scarcity. Wood's argument relies on the core mechanics of supply and demand.
If you zoom out and you look at the longer-term price chart of Bitcoin, what you'll see is gold often leads, and certainly in the last two cycles, Bitcoin's performance.
It demands that investors separate immediate price action from underlying structure. Physical gold has a major, unavoidable flaw. Its supply is fundamentally elastic. When the fiat price of gold spikes, mining becomes highly profitable. This incentivizes global conglomerates to dig deeper. They deploy advanced technology to reach previously unprofitable reserves. This physical effort artificially expands the global supply of gold. Eventually, that expanded supply dampens price appreciation. Global physical gold supply currently expands by about 1.8% annually. Bitcoin represents a historic breakthrough in absolute inelasticity. Its total terminal supply is hard-coded at 21 million coins. It is governed by an unalterable cryptographic protocol. No amount of human intervention can change this schedule. No corporate profit motive can mine more than the code allows. Wood explicitly highlights this structural advantage. Bitcoin is inherently scarcer than gold. Its new issuance was growing by roughly 0.8% annually. After the 2028 halving, that drops to an incredibly low 0.4%. It maintains a persistent, expanding mathematical advantage over physical commodities. It is the ultimate scarce asset. But scarcity alone does not explain her absolute conviction. She believes Bitcoin serves a purpose that gold simply cannot match.
Well, if you look at the correlation between gold and Bitcoin, you'll see it's very low.
The Dual-Hedge Hypothesis. Traditional finance categorizes defense assets into strict buckets. Gold hedges against inflation and fiat debasement. US Treasuries and cash hedge against deflation and economic contraction. Wood's thesis radically departs from this legacy framework. She posits that Bitcoin is a modern hedge against both scenarios. In a highly inflationary environment, the capped supply works beautifully. It protects purchasing power against unchecked central bank money printing. But what happens during a severe deflationary crunch? What happens when banks fail and counterparty risks cascade? Bitcoin serves as an unconfiscatable, decentralized bearer asset. It operates entirely outside the traditional fractional reserve banking system. It carries exactly zero counterparty risk. A physical rock in a highly regulated, centralized vault cannot offer this. legacy institutions routinely require state bailouts to survive. A secure hardware wallet holding sovereign cryptographic keys does not. This digital nature sets Bitcoin completely apart in modern finance. It offers a defensive utility that physical commodities lack. But even with this utility, why is the price crashing right now? Because Bitcoin is trapped between two completely different generations. The demographic time bomb. We have to look at the broader cultural conversation. Physical gold demand is maturely and deeply entrenched. It sits in the reserves of sovereign central banks. It is locked in the legacy portfolios of traditional wealth managers. Because it is fully mature, its capacity for exponential appreciation is limited. Bitcoin remains in the very early phases of global adoption. The current volatility is a symptom of this early adoption phase. Wood's thesis relies heavily on impending demographic shifts. We are facing a massive generational wealth transfer. Trillions of dollars will move from older generations to digital natives. Older cohorts implicitly trust physical commodities and legacy institutions. To them, physical gold feels real and safe. To younger demographics, digital scarcity is an intuitive concept. The friction of acquiring, insuring, and storing gold feels anachronistic. Digital natives routinely call physical gold boomer rocks. This generational divide was vividly illustrated during the February crisis. The administration implemented highly prohibitive immigration policies. They added a massive $100,000 application fee for H-1B visas. They introduced a literal $1 million Trump Gold Card for ultra-wealthy residency. Wood admitted on air that these barricades to human capital through her firm. She champions a borderless, permissionless digital future. Meanwhile, the government was commodifying residency with literal gold branding. It was a stark juxtaposition of legacy power versus decentralized networks. The old system relies on physical gates and extreme wealth thresholds. The new system relies on open source, borderless cryptographic proof. As wealth inevitably changes hands, the capital will follow the technology. The final resolution. The friction between these two worlds is reaching a boiling point. Peter Schiff is actively weaponizing the current market crash. He argues that Wall Street permanently corrupted Bitcoin. He claims the asset is blind to impending macroeconomic reality. He likens crypto investors to deer staring into the headlights of a Mack truck. And if you only look at the last 139 days, he looks like a genius. But Cathie Wood is playing a completely different game. She is not looking at the current quarter. She is looking at the fundamental mechanics of the next decade. The digital gold narrative is currently battered and bleeding. It is enduring the most severe macro stress test imaginable, but the underlying math has not changed one single bit. The 21 million cap remains absolutely unbreakable. The network continues to produce blocks without interruption. The demographic shift towards digital native assets is entirely inevitable. Wood's hands-down comment was not delusional rhetoric. It was a calculated bet on mathematical certainty over emotional panic. The current crash is brutal and it hurts. But it might just be the last great shakeout before the paradigm shifts permanently. The era of elastic commodities is ending. The era of absolute digital scarcity has already begun.